The most important number in your entire financial life just flatlined, and almost no one is paying attention. Every dollar sitting in your bank account, every credit card balance, from your mortgage to your car loan, all of it, and I mean all of it, is priced off of one single number. And this week, that number broke. That number is the interest rate on the US 10-year Treasury bond. It just spiked to 4.6%. And while that might seem like a dry, meaningless data point, it most certainly is not. I am going to show you how something this big breaks and why it hits you personally in ways that most people will not see coming. Doug Casey, legendary investor, author of the New York Times bestseller Crisis Investing, calls the 10-year Treasury yield the beating heart of the dollar-based fiat system. Put a stethoscope to that heart today, and what you hear is flatlining. I'm going to tell you what just happened, and more importantly, what's coming next. This video is about how the rules that investors have relied on for the last 50 years have just stopped working. And while everyone dances through the bubble, Warren Buffett is sitting on record cash levels and warning you that AI and tech stocks will not save you for what is coming. It's about the two international buyers that have kept the US solvent for decades, and why both of them right now are walking away from the table. It's about a war in the Persian Gulf and the asset being used to settle it. And it's about the impossible choice the US government now faces. Two options that directly threaten US global dominance. And how Uncle Sam's hand is already being forced, with the bill coming directly out of your bank account. Stay with me to the end, because whether this goes left or right, there is one position that wins either way. And most people will not see it until it has already moved. This is the defining financial story of the 21st century. And it is about to touch every single aspect of your financial life. So it is crucial that you connect these dots now, before you realize it is already too late. Now, before we go any further, you have to understand one thing. It is the math that explains the rest of this video. And it is pretty simple. They just don't talk about it at school. When you buy a bond, you're loaning money to someone, usually the government. And in return, you get a fixed payment every year. They keep your money for a set period, and then at the end, you get it back. Let's say you buy a $1,000 bond paying 4%. It pays you $40 a year. In 10 years, you get your $1,000 back. Now, a year passes. The government starts issuing new $1,000 bonds paying 5%. So the new one yields $50 a year instead of $40. Nobody wants your old 4% bond anymore. Why would they when the government is offering a juicier deal? So if you do need to sell it, you can't get $1,000 for it. You have to drop the price to say $920, maybe $900, until the buyer is getting the equivalent of the 5% they can get on the open market. And that is the whole game. It's an inverse relationship. Yields go up, prices go down. Two sides of the same coin. Here's why this matters right now. There are over $100 trillion worth of bonds in the world. Every retiree's safe portfolio, every insurance company, every bank's balance sheet. They are all sitting on lots of bonds that were bought when yields were near zero. As yields rise, the value of every single one of these bonds falls. And those losses cannot just be written off. They sit on a balance sheet like a slow leak until someone has to sell. Now here is where it starts to get funky. From September 1981 to August 2020, the yield on the 10-year US Treasury fell from 15.8% to 0.5%. For nearly 40 years, bond yields moved in one direction, down. And because it's an inverse relationship, as yields went down, the price of those bonds went up. It was one of the most epic bull runs in modern financial history. But think about what that means. From every fund manager you see on CNBC, to every advisor managing your retirement account. If they are under the age of 60, their entire career happened under that one secular bull trend. They have never managed a single dollar in a sustained rising rate environment. Their mental models literally do not know how to compute it. The 200-year rate cycle data is brutally clear on what comes next. Every previous rate peak has lasted between 56 and 67 years. The 1981 top was 15%. The 2020 bottom was 0%. Today, it's 4.5%. The trend has reversed. The 39-year bull market in bonds is over. We are at the very beginning of a new cycle running the other way. The people in charge of your money are about to discover that the world they spent their entire careers inside no longer exists. And your financial life is dependent on you being aware we have entered a new paradigm. And so how is the rest of the world reacting to this news? Well, for decades, the US Treasury auction worked like a vacuum. The world always showed up to buy US debt, as the architecture of the entire dollar system depended on it. There were two main buyers that carried a lot of that load. And now, both of them seem to be walking away. But before we get to who's leaving, you have to understand why it's happening. In 2020, the Federal Reserve printed in excess of $5 trillion as COVID had ground the nation's economic wheels to a halt. To put that in context, the entire response to the 2008 global financial crisis was $700 billion. 2020 was 7 times bigger. And nobody can be certain of the number for the next print, but math proves that it must be larger. When you print money on that scale, two things happen. The first is inflation. Things get more expensive, and through the 2020s, we have all lived through that. The second is possibly even more important, and most people miss it. The bondholders of the world looked around at what just happened and asked themselves a simple question. If you're going to debase the dollar I lent you, I need to be paid more dollars to compensate, or I'm just not lending anymore. And that sums up the entire reason yields are rising. Bondholders are demanding a higher return because they no longer trust the currency they are being paid back in. And now, layer on a war. War is historically the biggest driver of explosions in government debt. The Civil War took US debt up 4,000%. World War II, 410%. The Iraq and Afghanistan wars added essentially the entire federal debt that existed when they began. And now we are 3 months into the Iran war. US federal debt has already climbed from $38.7 trillion to over $39.2 trillion. Every basis point that yields rise adds roughly $4 billion to the government's annual interest bill. The 63 basis point move since the war began has already added an estimated $250 billion in annual interest costs. Annual interest on the federal debt is now over $1.2 trillion. It is the second largest line item in the federal budget, bigger than both defense and Medicare. This is the setup for where we are now. 40-year-long yield go down trend has reversed. The printing got worse and worse over the last 20 years. Our latest foray into the Middle East made it accelerate. And now the two most reliable buyers of our debt are being forced to walk away from the table. Buyer number one, the Gulf states. Since Nixon closed the gold window in 1971, the dollar has been backed by a deal based on one commodity: oil. The agreement was simple. Saudi Arabia, the UAE, Kuwait, Qatar, Bahrain. As long as the US military agrees to protect them, they agree to sell their oil for dollars. They then take all their excess dollars and recycle them back into US treasuries. This, my friends, is the petrodollar system. This is how the United States has been able to run trillion-dollar deficits and not see its borrowing costs explode. The Gulf states are willing to buy our debt at every auction. But since the Iran war broke out, that system is breaking. The Strait of Hormuz, where 20% of the world's oil moves every day, has been shut down. Oil infrastructure across the region has been damaged. The Gulf states are pumping less, exporting less, and earning fewer dollars to recycle. Treasury International Capital Data has just confirmed that Saudi Arabia and the UAE have reduced their treasury holdings. When the UAE floated the idea of selling part of its $285 billion worth of Treasury reserves to offset its lost oil revenue, U.S. Treasury Secretary Scott Bessent offered them a swap line instead. His own words were that this was intended to prevent the sale of U.S. assets in a disorderly way. The Treasury Secretary is publicly admitting that he is engineering workarounds so that our allies do not dump our debt. And it gets worse. Iran has begun demanding tolls for safe passage through Hormuz. The toll is roughly $1 per barrel, and it cannot be paid in dollars. They are accepting two things: Chinese yuan and Bitcoin. Iran has launched a sovereign-backed maritime insurance program called Hormuz Safe, which allows ships transiting the strait to purchase coverage using Bitcoin. The Iranian Economy Ministry estimates that it could generate over $10 billion in annual revenue. More than 20 countries have reportedly accepted these terms. Japan, which gets 90% of its oil through Hormuz, is reportedly one of them. Take a second to let this sink in. Iran, the most heavily sanctioned regime on Earth, operating the most strategically important choke point on the planet, is settling oil-related payments in Bitcoin. They did not pick Bitcoin because they heard Michael Saylor say that it's going to $20 million a coin. They picked it because dollars can be sanctioned, yuan settlement still routes through Beijing, and Bitcoin is the only neutral settlement layer left for a state when they are cut off from the global financial system. Bitcoiner game theory is actually playing out. The petrodollar is being replaced by the currency that cannot be stopped. All right, that brings us to big buyer number 2, Japan. For 30 years, some of the smartest traders on Wall Street made the same bet. They shorted Japanese government bonds. They were certain that Japan could not maintain artificially low interest rates forever, and that the day would come that those rates would have to normalize. Their logic was sound, but that day actually didn't come. Year after year, decade after decade, Japan held the line, and every single one of those traders went broke waiting. Wall Street had a name for that trade. It was called the Widowmaker. But now it appears the Widowmaker has begun to pay out. Last week, the yield on Japan's 10-year government bond punched above 2.8%, the highest level since 2007. While the traders who placed that bet over the last 2 decades were vindicated, most of them are no longer in the business to collect on it. But here's why this matters for you. Japan was the other silent buyer at every US Treasury auction. Every Japanese pension fund, insurance company, and bank was forced to send its money abroad to find any return at all. A massive chunk of that money came to the United States. It bought our treasuries and propped up our stock market. It kept our interest rates artificially low. That flow is one of the biggest sources of cheap capital in the global financial system, and it has run for decades. It's known as the yen carry trade, and now that flow is reversing. As Japanese yields rise, Japanese institutions do not need to leave home for yield. They start selling their foreign assets, including treasuries, and bring that money back to Tokyo. The country that used to export liquidity is now starting to import it back. Japan walked into our future of astronomical, unpayable national debt first. Now they're standing there waiting for us in the elephant graveyard of bad outcomes. At this juncture, I would like to check in on who is still with me. If you've made it this far and I've learned something, comment the word Japan down below. Now stick around because I'm going to bring this back to America and explain what it means for you. Okay, that brings us to this week. Since 2008, the Federal Reserve has printed in volumes never seen before. And now US yields are rising because the world no longer trusts the currency that they will be paid back in. The 2 big buyers who held the auctions together, the GCC and Japan, they're both pulling back at the same time. And every basis point higher cost the US government nearly $4 billion in interest that it does not have. And now the question becomes, what do they do about it? There is one tool left in the kit. Just one. The Federal Reserve needs to step in, print money, and use that printed money to buy the bonds itself. They must do this at whatever price is necessary to keep yields from going higher. The technical name for this is yield curve control. In plain English, it means the government becomes the buyer of its own debt, with money it created from nothing, in order to keep its borrowing costs artificially low. That is the only path left. There really isn't any other option. If they don't do this, the interest bill on the federal debt eats the entire defense budget. Mortgage rates climb past 9%. Pensions and insurance companies get crushed on their bond portfolios. The stock market deflates as the credit system seizes. And the federal government runs out of money to fund itself. So they have to print dollars to buy their own debt and cap rates by doing so. But there is a price. When the government prints trillions of dollars and uses them to buy bonds, the dollars in your pocket lose value. The eggs at the supermarket cost more and the rent on your apartment goes up. The savings account you've been building for 10 years buys less and less every year. This is the choice the government is faced with. They can save the currency or they can save the bond market. They cannot save both. They are going to save the bond market. And the bill comes out of the purchasing power of your bank account. And if you think this is a theory, it has been done by an American ally after a similar war in the not too distant past. Between 1975 and 1985, Israel had run up its debt to GDP ratio to 260%, fighting the Yom Kippur and Lebanon wars. The Israeli government did not default, and it did not raise taxes to crushing levels. It simply allowed inflation to run hot, extremely hot. At its peak, Israeli inflation hit over 450% per year. Within a decade, the real value of all that wartime debt was eroded to almost nothing. And the bondholders were paid back in shekels that bought almost nothing. The state was saved while the savers were essentially liquidated. That right there is the playbook that will be copied. And before anyone tells you that the Fed will never do this, Pay close attention to what the new Fed Chair Kevin Warsh says in the coming weeks. They won't call it yield curve control or currency debasement. They'll call it stability or emergency liquidity. They'll call it whatever they need to call it. But the function will serve this purpose. Now, some of you are watching this thinking, I can protect myself if I just rotate into mega cap tech stocks like Google, Microsoft, Nvidia. I'll just ride out this inflation using AI stocks as an inflation hedge. The idea of trying to use stocks to beat inflation is not new, but it's also not correct. Warren Buffett wrote a piece in Fortune magazine in May of 1977. It was called How Inflation Swindles the Equity Investor. Buffett had observed for years how conventional wisdom said that stocks were a hedge against inflation because stocks represent ownership of real assets rather than claims on dollars. And he noted that this belief peaked in the mid-1960s, right before the world entered an era of accelerating inflation and rising interest rates that crushed equity returns for a decade. We are now in that same exact setup. Bank of America's Michael Hartnett tracks this. CPI inflation crosses 4%, the S&P 500 falls an average of 4% over the next 3 months, and 7% in the next 6. The current CPI reading is 3.8%, which means we are getting very close. The same currency debasement that is killing the bond market is the same currency that Apple's earnings are reported in. You are trading a debased bond for an equity measured in debased dollars. Both of these are tickets to the same theater, and that theater is on fire, and you are the cartoon dog sitting there saying, this is fine. So if you can't trust the currency, and you can't trust bonds, and you can't trust equities, what do? There is an economist out there named Manico. He posted something recently that I've been thinking about a lot lately. Quote, investors in 1922 Weimar Germany and in 2017 Venezuela who waited for a dip in gold prices to get rid of their dying currencies were wiped out. We are at a stage that you need to get into the lifeboat. Doug Casey, the man we started this video with, believes the lifeboat is gold. He's been right about the disease for 50 years. He has a long-term track record of understanding what governments do when they run out of options. Where I think he's wrong is the cure. Gold worked in 1971. When information traveled at the speed of rotary phone calls. We don't live in that world anymore. The bond crisis that we just walked through is going to play out in days, sometimes hours. Capital flows now move at the speed of an internet connection. Settlement happens before you finish reading the headline. You need hard money that moves at the speed of the world we actually live in. You need money that cannot be printed by a central banker, debased by a politician, and can't be cut off from the payment network because the government said it didn't like you. You need Bitcoin. And before you tell me that Bitcoin is a speculative asset that trades like a tech stock, look at what we just covered. The most isolated regime on earth, controlling one of the world's most contested oil choke points, is already settling oil-related payments in Bitcoin. Iran is demonstrating Bitcoin's necessity in a rapidly fragmenting multipolar world. Because there is no better option. You are watching the world choose its next reserve asset in real time, led by the people who can least afford to choose wrong. As Michael Saylor says, Bitcoin insight is restricted to those with a need to know. Right now, Iran needs to know. And soon, everyone will. This is the choice in front of you. The bond market is going to be saved. The currency in your bank account is going to pay the price. Federal Reserve and the Department of Treasury are not your friend. The financial advisor managing your 401k, the one who has only ever worked in a 40-year bull market in bonds that just ended, is not equipped for what is about to happen. The people in the lifeboat will be the ones who got there before the boat got crowded. Bitcoin is the only asset on earth where the supply doesn't change because someone in Washington went and picked up a phone. As Saifuddin Ammous put it, war is the grift that keeps giving. The war is the grift, the bond market keeps it going, and your currency is what foots the bill. If you got value out of this video, do me a favor. Share it with one person who still thinks that their bank account is safe. If you want to learn more about how the bond market actually operates, check out the latest interview I just did with market analyst Infra. Just click the link right here. Be sure to subscribe so you don't miss the next one. And if you're not already in the lifeboat, ask yourself why. I'll see you in the next one.